Have you ever heard of the term house poor? It's real, and it could happen even after you've made the biggest purchase of your life. Most people don't see it coming, and many agents don't tell you about this, but I will. Before you sign those papers, let's talk about the red flags. I'm making this video for you because I believe in the power of home ownership. It builds wealth, provides security, and creates a nest egg for you and your family's future. But here's the thing, not every time is the right time to buy. Today, I'm going to share with you 3 crucial signs that you're not ready to take that step, because being prepared is the key to avoid being trapped to becoming house poor. Let's first define what house poor means. The term house poor describes a situation where a person's mortgage payments, along with associated housing costs, consumes a significant portion of their income, leaving little or no room for other expenses or savings. This can lead to financial strain and reduced quality of life. I wouldn't want any of my buyers struggling to make ends meet. Here are my 3 crucial signs that you're not ready to purchase a home right now. Number 1, unstable financial situation. An unstable financial situation is a condition where the person or the household is experiencing an instability of income and expenses, therefore cannot meet their financial obligations. This instability can arise from various factors, including job loss or reduced income, unexpected unemployment, or decrease in wages can impact significantly your financial situation. Medical emergencies. Major health issues such as illnesses or accidents can lead to substantial medical bills and potential lost income due to time off of work. High levels of debt, including credit card debt, student loan debt, or other personal debts, can create a burden on your monthly expenses and make it difficult for you to save. Unexpected expenses. Unforeseen costs such as car repairs, home maintenance, and natural disasters can impact significantly on your financial situation. Economic downturns. Recessions or economic instability can lead to job losses, reduced income, and higher cost of living. If your income is inconsistent, you have significant debt, or you lack substantial emergency fund, buying a home might be premature for you. A stable income is crucial in order to make your monthly mortgage payments as well as taxes and other home expenses. Additionally, having solid emergency funds ensures that you're able to tackle any unforeseen expenses. Now, I've had buyers ask me, Kaori, what is an appropriate emergency fund amount? Well, generally speaking, a recommended emergency fund is approximately 3 to 6 months of your living expenses. This amount can vary based on your individual circumstances, the amount of debt you have, and also the number of people you live with in your household. Here's a breakdown of what your living expenses might look like. Housing, rent or mortgage payments, utilities, and property taxes. Transportation, car payments, insurance, gas and public transportation costs, food, groceries, and dining out, debt payments, credit card bills, student loans, and other debt. Other expenses, insurance premiums, medical expenses, entertainment, and saving contributions. By the way, if we haven't met yet, konnichiwa, my name is Kaori Nagao, your global real estate advisor, helping you find your new home. Whether it's a new construction home or a resale home, anywhere in the world, I'll be more than happy to help you. Remember, I have Sotheby's referral partners all around the globe, and they can help you with your home buying process. Thank you so much for watching. I really appreciate it when you engage with me. Let's keep going. Number 2, poor credit score. A low credit score can result in higher interest rates on your mortgage and a higher monthly payment and a higher monthly cost. If your credit score is low, you may want to focus on increasing that credit score before considering home ownership. This could save you thousands and thousands of dollars in the time span of that particular mortgage. Poor credit score impacts greatly on the type of loan you may qualify for. Lenders often use credit scores to assess your financial reliability and risk of defaulting on a loan. A lower credit score generally indicates a higher risk, making it more difficult to obtain favorable loan terms. Here's how a poor credit score can impact your home loan prospects. Higher interest rate. Lenders may offer higher interest rates on home loans to borrowers with lower credit scores to compensate for the increased risk. This can result in significantly higher monthly payments and overall loan costs. Limited loan options. Many lenders may be less willing to offer home loans to borrowers with poor credit scores. This can limit your options and potentially prevent you from purchasing your desired home. Down payment requirements. Lenders may require a larger down payment from borrowers with lower credit scores to mitigate their risk. This can make it more challenging to save for a down payment and purchase a home. Additional fees. Some lenders may charge additional fees or require specific conditions, such as mortgage insurance, to approve home loans for borrowers with poor credit score. You see, I could help you improve your credit scores by doing a deep dive of your current financial situation with one of my lender partners. I have a handful of lender partners that I could recommend any of my buyers by understanding their financial situation. Every mortgage company has unique loan types that could fit based on the appropriate buyer's situation. Just to give you an example, it's much easier if a buyer has a steady income with a W-2. Things will look differently if you're an entrepreneur running your own businesses with a 1099. Here are some steps in improving your credit score and increasing the chances of getting approved for a specific loan. Check your credit report. Regularly review your credit report for errors or disputes. Pay bills on time. Consistent on-time payments are crucial for improving your credit score. Reduce debt. Lowering your debt-to-income ratio can make you more attractive to lenders. Limit new credit. Avoid opening new credit accounts unnecessarily, as this can temporarily lower your credit score. Consider credit counseling. A credit counselor can provide guidance on improving your credit and managing debt. Now, did you know that there are alternative options for borrowers with low credit scores? Government back-end loans. Programs like FHA loans and VA loans have a much lower credit requirements compared to other loans like conventional loans. Credit unions. Credit unions may be more lenient on your credit score compared to banks and other financial institutions. Homebuyer educational programs. These programs can help you educate financially and counsel so that you're better prepared for home ownership. While a poor credit score can present challenges, it's important to note that your credit score can improve over time. By connecting with one of my lender partners, you're able to increase your credit score so you'll have more options when it comes to different loan types and home buying processes. Now it's time for a pop quiz. I know you've been waiting for this. The first person to comment correctly will get a shout out on my next YouTube short. Let's go. How do you calculate emergency funds? A, 1 to 3 months of your living expenses. B, 3 to 6 months of your living expenses. C, 6 to 9 months of your living expenses. And D, none of the above. Number 3, lack of long-term commitment. Buying a home is a long-term investment. If you're unsure about staying in one place for a long time, renting may be a better suit for you. Real estate typically appreciates over time, but the costs associated with buying and selling a home can negate any short-term gain. If you're not ready to commit to a location for the long haul, it might not be the right time to buy. Now let's talk about this a little bit further. In my buyer's consultation, I always ask the question, it will depend on your situation. Let me give you a couple of examples. Let's say you're a first-time home buyer and this is your first home. Maybe it's too much for you to purchase a single-family home, so you're going to start with a townhome. That's a great idea, you guys. Let's say you want to live in this townhome for a couple of years, but after that, you want to leverage the tax-exempt rule and move up to a bigger home. And that time, maybe it's a bigger townhome, or maybe it's a single-family home. Maybe you're an executive and you've relocated to Las Vegas and you don't know if you're going to be here long-term. Then yes, maybe renting is a good time, or do a short-term rental while you decide if this work is a long-term for you. And at that time, you could decide if you want to buy. Let's do a deeper dive on this capital gain tax exemption rule. Have you guys heard about it? Do you know what that is and how you can leverage that to move up from your starter home to your move-up home? Let's dive in. In Nevada, if you've lived in your home as a primary resident for over 2 out of the 5 years preceding the home sale, the IRS lets you exempt $250,000 in profit if you're single, or up to $500,000 if married or filing jointly from capital gain taxes. So what does that mean for you? This means that you can leverage these tax savings and roll over that capital gain from your home sale into your brand new move-up home. If you're curious about learning more about these tax-exempt rules, reach out to me. We can schedule a buyer's one-on-one consultation. For more videos about new construction homes, or if you're considering buying new anywhere in the world, make sure you check out one of my videos surrounding me. Thank you so much for watching. If you're new to my channel, welcome. It'll make me really happy if you could smash that subscribe button and hit that notification bell so you're made aware of my weekly content. You guys, I want to hit 10K subscribers by the end of this year. So help me by sharing my videos with any of your friends and family. I really appreciate you watching, and I cannot wait to see you on the next one.